Right. Good evening. Can you hear me? Just confirm, please, before I continue.
Yes.
Oh, I'm audible enough. That's wonderful. Right. So, welcome to another session in Audit and Assurance, where I'm going to be unveiling to you colleagues, still dealing, of course, with audit evidence part 2. But in this particular segment, or rather session, my special emphasis today is with regards to inventory. Right. So the best way I'm going to be explaining inventory to you is by looking at what is known as the inventory and production cycle. So what you discover basically is when you're looking at the inventory and production cycle, essentially this is one of those processes that deals with production of inventory. But I think before we can even look into that, I just want to explain some few important things, basic concepts rather, with regards to inventory that I feel or that I think you guys need to really know. Whenever you hear of inventory, one of the things that should come into your mind is inventory can be classified into 3 different distinct groups, namely raw materials. Number 2, work in progress. Let me write it in full: work in progress, which I can abbreviate the WIP. And thirdly, another type of inventory items that you can also find is identified as finished goods. These are the 3 distinct types of inventory items, or other types of inventory itself. So it can be in form of raw materials, and these raw materials for production purposes would be assembled or would be manufactured. And in the process of manufacturing, what you would discover is there's a stage or a state in which a product is still undergoing development phase. We call that work in progress, right? So from the work in progress state, essentially what you will observe there is actual production process of the finished goods, which is what we intend to achieve rather at the end of the day. So I'll call this FG just for abbreviation's sake, so that when you see me now abbreviating as I explained, you know what exactly am I referring to. This one I'll call it RM, simply standing for raw materials. So this is basic types of inventory items that you would find. Then just to add on to that, how do we measure inventory? So I'll call this inventory measurement. Inventory measurement. Right, that's very, very important. I think these are basic things I just want you to observe. So we measure inventory at lower of costs or its net realizable value. Maybe I should just write this thing in full. So NRV stands for net realizable value of inventory. So a net realizable value, it's almost one of the same thing as saying market value of the inventory on a particular date, right? So when we are measuring inventory, in other words, when we are recognizing inventory costs in our records, in our financial records, we recognize inventory at low of cost or the net realizable value. So for example, just to illustrate that aspect, I'm teaching a bit of accounting there anyway, just to illustrate, right? So let's say the cost price of inventory is, I'm going to use dollars there, $1,350 US. That is the cost price of inventory, suppose at year end, right? Maybe that is the value of inventory that we have at cost price. And then we are told, well, the market value though, the market value of this inventory is 1,200 US dollars. Now, question comes, at which price should you recognize inventory in your books? Just a simple basic question. So we come back to the measurement rules of inventory, which simply states that you measure inventory at lower of cost or the net realizable value. So it means when I'm recognizing the value of inventory in my books, I look at the lowest value between the cost price and the market value. So if I'm comparing the cost price of 1,350 US dollars versus the market value of 1,200 US dollars, which one is the lowest between the two? That's a question I'm asking.
The market value.
Definitely the market value. So in other words, if I have drafted the statement of financial position somewhere there under the section assets, to be more precise, current assets, all right? So I'll just put current assets somewhere there. If I go to the current assets section, I would find the inventory item and the value at which I'll be measuring this inventory, it will be 1,200 US dollars, not 1,350 US dollars, though that is the cost price of inventory at that particular period. So you would recognize it at the lower between the two values. Is it making sense, sisters?
Mm-hmm.
Right. So those are some basic concepts I just thought I should highlight and bring to your attention. Okay. Right. I don't want to complicate it or start teaching you accounting or cost management accounting. So what I want to do, or what I want to deal with, is the auditing side of it. So when we're now looking at inventory, but from an auditing perspective, how do we view inventory? And in this context, I'll be introducing you to one of the other business cycles, which I outlined from our mind map. So maybe just to remind you of our mind map, I'm going to draw a whiteboard quickly. I'm going to draw a whiteboard here, just so that I can show you how this thing would look like. So essentially what I want to do is I'm just trying to show you the mind map in relation to business cycles. Right. So here, I'll title that business cycles. Remember, with business cycles, it's simply one and the same thing as saying process activities. So if I go to any organization, one of the things I would observe as an auditor would be process activities. Of course, my special focus as an external auditor is with regards to the fairness of the presented financial records, as well as the financial statements. That's what I'm mainly concerned about. But from an auditing perspective and background, I need to have a good understanding of the activities, right, that are taking place in the organization. Perhaps some of them would actually influence some of the values that we see in the financial reports. And for example, this particular one I'm about to deal with, which is inventory and production cycle, it is one such process activity that has a significant influence, especially with regards to the presentation of our financial statements. Now, so we already discussed the first one here, which is revenue and receipt cycle, right? Let me try to make it look neat. Don't like to make it look very ugly. So the first one which we dealt with was revenue and receipt cycle. We already dealt with that. The second one, which is basically the opposite of that, it is called acquisitions and payment cycle. And the third one, which is really what I wanted to focus on because I was following the module outline anyways, it's inventory and production cycle. The fourth one, which I will deal with, is with regards to payroll and personnel cycle. And also equally important is the fifth one, which is called finance and investment cycle. Right. So these are the 5 essential process activities or business cycles of note that we are going to be looking at. And obviously the reason behind us going through each one of them is so that we can be able to achieve this objective. Gathering audit evidence. How do we gather the audit evidence? We can only gather sufficient, appropriate audit evidence if we have a good understanding of what exactly is transpiring within the organization. What activities are they performing? So if they are selling something, definitely there is a revenue and receipt cycle or process activity that they are following. If they are buying something, perhaps maybe for resale, then there is an acquisitions and payment business cycle which they are following. But if it's perhaps a business which is in the manufacturing sector, well, they would follow the inventory and production cycle, which is what I'm going to discuss with you today. And basically, you would observe with the inventory and production cycle, it actually incorporates both revenue and receipts as well as acquisitions and payment cycle in one. You're going to see it shortly. Then there's payroll and personnel cycle. This one really deals with people, right? How management is especially the human resource management, ensures that the company hires competent personnel that are qualified and skilled enough to execute their duties to the company, intend to ensure that corporate objectives are attained. Then we have got finance and investments business cycle. Now with the finance and investments business cycle, what you would observe there, this is now where I would introduce you to the next aspect in our module outline, which is called bank and cash. So basically, your knowledge of bank reconciliation also becomes handy when we begin to look at that. But it doesn't only deal with bank and cash only. In finance and investments, it also addresses the aspects to do with non-current assets. Basically, these are aspects to do with audit procedures or substantive audit procedures that they will require you to perform in the exam. Same thing with the, okay, now using the work of others. Now this is, we call this one the auditor's expert, but that is something that is completely different. But of course, it's another area, or rather another way of obtaining evidence that an auditor can actually use in order for them to comment or to give an opinion with regards to the presented financial records. Now, but for today, we are focusing on inventory. So let's have a look at the inventory and production cycle. Now, maybe before we continue to go into that, I just need to outline some few important things. So this is what we are looking at, right? Inventory and production cycle. Let's start off by looking at what is it that I need to understand or know from here. So that is our assumed knowledge, right? Assumed knowledge. So let's have a look at the assumed knowledge of what we need to know from this cycle. So number one, obviously, you need to have an understanding of the characteristics of the cycle. What is it that distinguishes inventory and production cycle from any other business cycle? Secondly, you need to know the stages in that cycle or functions within the cycle. Thirdly, if you know stages and functions, you also should therefore be able to recognize the people involved. And very important, whenever you're looking at people involved, think of their titles. So if I'm looking at a warehouse area, for example, who are the people in that warehouse department? Obviously, there's a warehouse manager, there are warehouse clerks, there's a security personnel, perhaps handling the issue to do with access. These are the relevant people. So whenever I'm commenting, maybe performing a procedure and I'm observing the person, I need to be precise to say, observe the warehouse clerks, observe the security personnel in the warehouse section, observe the warehouse manager. So you always use their titles. You don't say observe John. You don't say observe Steve. You know, you don't use the actual names. You use their actual titles. So if maybe John is the warehouse clerk, then you can say observe the warehouse clerk. In brackets, you write John. You know, maybe there's a specific procedure you want to ascertain with regards to what John is doing. Right, so that's important. So people involved would also articulate to departments involved. It would also articulate to departments involved. If you know all this, you should therefore be able to be in a position where you can identify the documents which they are using, as well as the records that are being generated within the different respective functions in that cycle. And then lastly, but not least, and this is something they can actually ask you to do, to identify risks. They'll call this business risks. Normally, if they do that, the next question would be then for you to give a recommendation. They would ask you to give a recommendation, and the recommendation simply refers to an internal control, something that can actually address the risk identified. These are this is the assumed knowledge that you guys need to have. And just to add to that, because sorry, just in case if you are still copying, I can give it a minute. So while I'm explaining this to you, the other thing that you should also think about, I'm about to write it on the next page rather, so let's just maybe, I'm still continuing with assumed knowledge. When they ask you to draft audit procedures, when it comes to audit procedures, sometimes they can either specify to say perform the like substantive audit procedures with regards to the inventory account balance and to ascertain the following assertions. Right? So whenever they mention about assertions, what should come into your mind should be the following, that okay, if I'm performing audit procedures to test assertions, it depends with which assertions they are dealing with, because assertions can be grouped into two. There's assertions that specifically deals with transactions and some generated records in the company. Then we've got those assertions that specifically deals with account balances, and these are ledger account balances here, all right, or the actual account or amount that you would reflect in the financial statements. So you need to know the assertions. So when you're looking at transactions and records, one of the things you would test is to test for occurrence. You want to check whether the transaction occurred. Number two is to check for accuracy of the transaction. It's actually accuracy and valuation. One of the other things you'd want to check, still dealing with transactions and records, is to test for completeness of the transactions pertaining to assertions and records. You'd also want to confirm whether the transactions that have been recorded, they fall within the appropriate accounting period, and we call that the cut-off assertion. Then one of the other ones, which they hardly test, is the presentation assertion, valuation, and allocation over there, just to list a few. Then we go to account balances. Obviously, with a balance, I don't want to test, I don't want to test whether it is okay, because a balance doesn't okay, but a balance should exist. So what a session is that we'll be testing for existence. With account balances, yes, I also want to confirm whether there is accuracy. So yes, so in this case, it would be accuracy, valuation, and allocation, like that. Similar to transactions and records, we also test for completeness. Okay, there is no cut-off when you're dealing with account balances, but definitely there is need for you to account for presentation as well. Just to name a few. So if ever they ask you for audit procedures, my sisters, they can be specific to say, perform the audit procedures on the inventory account for the following assertions. So they can mention occurrence, then you know, okay, with occurrence, I'm dealing with transactions and records. So I need to test, I need to look at now what should come into your mind. The moment you see the mention of assertions, you should then think of your accounting process. Remember this. And I always keep writing this to remind you that the accounting process always starts with source documents, which should be captured in subsidiary journals. From the subsidiary journals, we summarize the totals from our journals and we capture them in the general ledger. From the general ledger, we summarize the closing balances in one statement, which is known as a trial balance. And from a trial balance, we have drafted financial statements. There's at least 4 of them, namely, what and what and what. There is PLOCI, which is the statement of profit or loss and other comprehensive income. There is statement of financial position, previously known as the balance sheet. There's SCE, which is statement of changes in equity, and there's what? Statement of cash flows, or basically the cash flow statement. These are the 4 set of financial statements according to the conceptual framework. Then we go to the trial balance. Like I said, this is just a summary of ledger account. But if I'm dealing with assertions of transactions and records, where is my focus in the accounting process? My focus is here. So if I'm dealing with transactions, so whenever you see me writing TX, I'm simply referring to transactions. Whenever I'm dealing with transactions and records, my focus is between these 2 places. But the moment I shift focus and I'm now dealing with account balances, what I'm looking at then is from here to here. So from the GL, TB, all the way to the financial statements, those are account balances that I'll be dealing with. Okay, so that's quite important. I thought I should emphasize that. Now, so whenever you hear of assertions, maybe it's pertaining to transactions and records, in your mind you should be thinking, okay, so the focus, it means it's really from here all the way to here. So what should I have in my mind, apart from, yes, understanding the process, where it starts and where it's ending? What is within the source documents? What is it that I would find in the subsidiary journals? So obviously, if I'm dealing with inventory, that's why I was telling you that it's important to understand the documents used. So as I'm taking you through the cycle, I'm trying to just really give you the documents that will be used. And then obviously, where do I see the records of this source document? The records is basically the journals. Is it making sense now? So your journals is what summarizes all the transactions from the source document. So in the source documents, in this case, we are simply referring to the following. things such as the tax invoice, things such as purchase orders. So I'm going to abbreviate purchase orders, things such as a purchase requisition form, things such as the delivery notes, documents such as receipts, things such as bank statements. I can write a whole lot of documents here that can act as source documents, but just to list a few, those are what we refer to as source documents. Then obviously the records is subsidiary journals. So you should have a bit of a background on this. That could refer to your cash book, which is made up of cash receipts journal and the cash payment journal, right? But we've got other journals. Apart from that, there is a purchases journal, there is sales journal, there is a general journal, there is a purchase returns journal. A purchase returns journal, etc. and etc. All this is what makes up your journals, right? So I'm just doing this just to help to you guys to recap, right? So now let's go back now into our notes so that we can now focus on this thing called inventory and production cycle. So when you're looking at inventory and production cycle, you'll observe that like any other cycle, it would comprise of functions or stages. So I'm going to identify this as stage number 1, that is stage number 3, 2, 3, and then that's 4, that's 5, and then that will be stage number 6. Then also, I think just before we go into all these steps, I've got a source reference, which is a textbook, just to show you the characteristics of this business cycle. In other words, how do I identify that in a context of a scenario, I'm dealing with inventory and the production as a cycle. So one of the common things about inventory and production cycle, which you're going to observe, is that it forms base as heart of the business. In other words, anything pertaining to that entity, it has to do with production of inventory. So in other words, also, it's one of the things that establishes the type of industry of operation for that particular entity, right? So very, very important, because without it, otherwise the company will not be able to have continued business operations, because their main stream of revenue would be coming from producing products and selling them to third party, which is the end user. And another important aspect to note with regards to the characteristics of this cycle is that it does have a significant effect on the financial statements, with special focus really being on the statement of financial position. But look, in as much as we deal with material misstatements, if one financial statement, like for example, SFP is affected, it directly have an influence, for example, on the statement of changes in equity. Why? Because for you to get the value equity, you need to take in consideration the net between assets minus the liabilities. So if the assets are manipulated, guess what would happen to your equity? Your equity value would not be correct. So that's why this aspect to do with inventory, or the concept of inventory itself, it really has a significant effect in the financial statements, because one of the things that would happen is inventory account balances in the statement of financial position can be overstated. So in other words, management would actually record more inventory than what they actually have in their warehouse. So that's why it has got significant effects in the financial statements. And very important, again, when you deal with the inventory and production cycle, this is one of those cycles which are more to do with internal activities. So most of the activities you would see during inventory and production, it's really internally based. It's only in two aspects where there is involvement of third party. Number one, it's when we are buying raw materials. And number two, it's when we begin to sell the finished product to the end user. Okay? And very important with inventory, obviously, there is tangibility side of it. Why? I mean, because obviously, when you are producing the actual product, you are physically using or combining the raw materials available to your disposal. So the other important aspect is when you're dealing with this concept of inventory and production cycle, there is involvement of physical assets. So if they are physical assets, it means that they can actually be stolen. It also means that they can actually deteriorate in value if they are not properly handled. So those are some of the things that we should be thinking about. And very important, there is high frequency or probability of fraudulent activity when it comes to inventory. And that fraudulent activity, typical example is where management would record more value of inventory in their financial statement than what they actually have in stock. And just to also add on this, but this will be the last aspect, there is diversity when it comes to inventory. So you discover when you go to the warehouse area of any organization you can think of, which is into the manufacturing industry, you'd notice that they've got different shelving levels or different shelving types rather, and what determines the variation in terms of the shelving system put in place, it is the following aspect: the nature of the inventory. Okay, and obviously the nature of the inventory determines where it can be located. So it can either be like, for example, if it's highly expensive type of inventory, you not normally just find it in store. What you need to do is you place an order, then they will deliver. All right, because otherwise, if they keep such high valuable inventory on store and not necessarily keep it securely at the warehouse, they would have high frequency of theft or robbery, so to speak. Okay. And also, again, another important aspect is to consider is the permanency of the inventory, and of course, the stage of development. Stage of development, that's where those three types of inventory levels that I've mentioned comes into the picture, which is raw materials, work in progress, as well as finished goods. Right. Then now we come back to our summarized notes, because this is what is more important. So the the 6 important functions which you guys need to take note of are the following. Number one, it starts with material requisition. Number two, it is followed by receiving of raw materials. Number three, followed by storage of raw materials. Number four, followed by manufacturing or production of the actual inventory items. And number five, followed by storage of finished goods. And lastly, the delivery of finished goods to the end user. Now, let's have a look at the first function. So what I'm going to do for each of these functions, I'll first of all start by discussing people involved, documents involved, and their core objective. So let's start with material requisitions and ordering. What exactly is the core objective of material requisitions and ordering? Essentially, their objective is to ensure that the organization acquires the required raw material needed for production on a timely basis, and that meets the quantity requirements, the quality requirements, and the set descriptions of raw materials required. Very important. So that is the core behind material requisitions and ordering. So who are the people that we see involved, or perhaps departments or divisions? We see a warehouse department. We also see a purchases department, also commonly known as the procurement department. Warehouse department, who is responsible, or who are the respective individuals in the warehouse? We see the warehouse manager, we see a warehouse clerk, and any other warehouse employee, possibly even the security personnel as well. In the purchases department, mainly the purchases manager, as well as the purchases or procurement clerks. Those are the people involved here. So what form of documents do these people use? From the warehouse department, we're going to receive an initiated material requisition form. This is just an internal document that authorizes ordering of raw materials with a supplier. So without a material requisition form, orders or purchase orders for raw materials cannot be initiated. So we need to have an accompanying material requisition form for purchases of raw materials to be performed. Then another set of document, obviously, is the material requisition, the ordering form. So basically, that is basically purchase order form. And then obviously just have the documents which I may not have necessarily included, but I think they are important for you to note. You also find them as we discuss, of course, the different functions. But in this book, what you would notice, they don't necessarily show them the way I have summarized, but basically these are the set documents you would see. I'm just showing you this for the sake of the documents. So you'll see goods received notes, but some of those, in my notes, you would observe them at the other stages. But just to summarize overall documents, here are the following documents you would see. So there's goods received notes, material requisitions, there's picking slips, material requisitions, issue note, there's delivery notes, there's transfer to finished goods note, perpetual inventory records, that's where inventory count comes into the picture. And then there's what we call inventory count documentation that is used as well. Overall, these are the common documents you would observe being used in the inventory and production cycle. Now, having said that, I take you back now to our cycle. So looking at this material requisitions and ordering function, we see a material requisition form. We see an order form. Just to add on this, you would also see a supplier list, because we don't just buy raw materials from anybody. We need to have designated suppliers for our raw materials. Right, so that's material requisitions and ordering. Second stage is called receiving of raw materials. So now that we've ordered the materials with the supplier, the next stage, we expect to receive the delivery of our order of raw materials from the suppliers. So when we are receiving the raw materials, we see what is known as the receiving section, which is just a segment within the warehouse itself. We also see that's basically a section in the warehouse, or sometimes other companies, they have them the receiving section as a separate section from the warehouse department altogether. But in terms of people involved, you definitely see a security guard being present when deliveries of raw materials is being done. We also see, of course, the actual delivery driver from the supplier, or maybe the one that we have hired to deliver our raw materials to us, being also present when this particular process is being performed. Then documents used, my sisters, will definitely see the use of delivery notes, copy of the actual original order, purchase order form, the goods received notes. We also see them being handy or being useful in this stage. Now, the next stage is called storage of raw materials. Now that we've received the raw materials, we need to store it for transfer to production, because that will be the next thing that will happen after we have stored the raw materials in the warehouse. We need to then transfer it to manufacturing or production process. But let's just have a look at storage raw materials and identify the people involved, perhaps even the departments that are involved. So in this case, my sisters, under storage of raw materials, you observe the warehouse department again, and you would observe obviously that under the warehouse department, there's a warehouse manager, there's warehouse clerks, and there's a security personnel possibly present at the access point to the warehouse section. Documents used, there is definitely going to be a use of transfer slips, production schedule, and just to outline on this, so it's made, okay, transfer finished, okay, no, not this one, but it's basically a transfer slip. Is just the same thing as picking slip. So the transfer slips that you are seeing here, transfer slips is a picking slip. So this is just a document that is used internally to authorize someone in the warehouse to pick the relevant raw materials and issue it to production. So you don't just go into the warehouse and start picking raw materials as deemed necessary, no, but it has to be documented, and that document that authorizes warehouse employees to collect raw materials and transfer them to production, we call that a transfer slips or a picking slip. Sorry about that. So these are the common documents that you would observe being used, right? Just a second. So, right. So proceeding further. So I was just in the process of explaining what document they use during storage of raw materials. So there's transfer slips, which is almost similar to a picking slip. So it's just one of those internal documents that is used to authorize movement of inventory from the warehouse section to production. Why do you think there's production schedules used during the storage of raw materials? Because we need to have some sort of a control measure that determines, that helps us determine when we should transfer raw materials to production process. So that is the use of production schedules in this context. Then coming back to the fourth one now, this is now where inventory production or manufacturing begins to take place. And that's where you also identify work in progress. If you observe from here to number 3, we're dealing with raw materials. But from here, from number 4 basically work in progress because you're busy producing the product. Number 5 to number 6, that's a finished goods type of inventory item that you'll be dealing with over there. All right. Then let's continue to the next one. The next one is manufacturing, right? And production. So what exactly transpired during production? Who are the people involved? You definitely see a production department, which is headed usually by a production manager, and sometimes a factory foreman. It depends with the structure that they have in place in that organization. Then you also see, obviously, the manufacturing employees also being part of that group. Then we've got documents used and records. Essentially, you'll see production schedules, which just gives us an outline of what quantities of goods are they producing and what type of goods are they really producing at a particular specified period of time. Maybe it can be weekly, monthly, or quarterly. That's a production schedule. So it just gives you an outline of, depending on the specified period of time, to say, okay, this is the X amount of inventory that they are producing and the type of inventory they are producing as well. Then there's production budgets. Production budgets, they're just there to ensure that there's cost effectiveness as far as production process is concerned. So we cannot be incurring more costs to produce a good, but at the end of the day, the revenue that we are getting is lesser than the cost we've incurred. It doesn't make sense. So we need to ensure that actually the revenue is higher than the actual cost that we've incurred, hence the use of production budgets. So it's just to ensure that there is feasibility studies applied as far as the production process is concerned. So is it feasible to produce the product or is it not feasible? It can only be considered feasible if you're going to be making money out of it. But if you're not going to make money, there's actually costs and loss that you're incurring, then it's not worth to continue. Then we also again see transfer slips used here. Why transfer slips in production? Because we need to account in the production to say how much of the raw materials did we receive from warehouse and how much of that did we use for production purposes. So they will definitely have a track record of such occurrences. Then there's production orders. We cannot produce. There are some industries where, yes, there's mass production, but there are some industries where production only happens if there is an order that has been received. Because otherwise, if they produce the product without receiving an order, what would happen is the product may not sell. Why? Because maybe the product is a seasonal product. Think of it in this context. If you are in winter, what do you think would happen to summer clothing? People won't be buying that thing.
They'll go and save.
People won't buy, it won't sell, you understand? So we need to have a production order. It's just one of other control measures that just guides us to manage our production costs. Right, and then there's a shift report. Why do you think there's need for shift reports? So that we ensure there's accountability with regards to production activities. If something is to go wrong during the production process, who are we going to hold accountable? Well, we just go back to the shift reports, and based on the shift reports, we will know who was responsible, or who was the factory foreman there when the unprecedented event or the undesired event actually took place. So shift reports, they're just there to ensure accountability. And then my sisters, we've got storage of finished goods. Now we've produced the product. The next thing is to ensure that we store the finished goods in the warehouse again. That's why there's sections in the warehouse. What is the determinant factor of structuring of warehouses? Remember the nature of inventory, right? The lifespan of inventory as well, the location of inventory. And just basically talking of these things, we're looking at it in three distinct measures. Is it raw materials? Is it work in progress? Is it finished goods? We don't have to power them the same. They will be powered differently. And also remember that when production is taking place, maybe the company is dealing with different types of products that are being produced. That's another determinant factor of where that set of type of inventory will be stored in the warehouse once it has been completely produced. So we see again the warehouse department, warehouse employees, warehouse managers. We see the use of inventory records such as inventory count sheets, inventory count registers. All these are essential documents which they will use during the storage of inventory. And this is very important. Inventory count sheets and inventory count registers. Why? Because that's what would help us to understand the inventory count records. I mean, yes, the inventory count process, not records per se, because these are the actual records anyway. Lastly, there's delivery of finished goods. Now that we have, the goods is ready for you, so for sale to the end user, the next thing is to deliver. In other words, to sell the product or to deliver the order now to the customer. So people involved in sales department, sales representatives, the actual driver that will deliver the good to the customer and the actual customer. So essentially, what I want you to see also, in stage number 6 of inventory and production cycle, we basically see revenue and receipt cycle, being affected. And from stage 1, 2, 3, we are basically looking at acquisitions and payments cycle, which is being performed right there. Then, of course, we see production itself, really, which is part and parcel of inventory and production. So effectively, the inventory and production cycle, it incorporates both acquisitions and payments together with the revenue and receipt cycle process activity. Then documents, obviously, I mean, if we sell something, we should, if we say for cash, there should be copies of receipts used, delivery notes to confirm that yes, the goods have been delivered to the customer. And then obviously there should be a use of customer order form. Now there are others which I just didn't indicate here, but there are some, like for example, a tax invoice. If a person is paid, I mean, obviously there has to be an invoice that you should have given to the customer for you to be able to complete the sale. Now that's inventory and production process activity of inventory and production cycle, summarized in simple terms by looking at the stages, people involved, documents and records that are being used. The next and very important thing I want to take you through is called inventory counts. Why do you think companies perform inventory counts, especially those that are into manufacturing? And I want to ask Sister Rhoda, why do you think companies perform inventory counts?
She vanished.
She's muted. I think my sister is tired.
She saw that question coming and
I understand. Do you want to give it a try, Sister Sina?
What's the question?
Why do you think it's important for companies to perform inventory counts?
Inventory is like stock. Stock. Is it stock?
Stock counts, yeah.
Okay. Stock count and stock taking, is it the same thing?
Yes, one and the same.
Yeah. Okay.
Yeah.
at least I'm
the same thing. It's just in interchange of terminology.
Oh, okay. I think to check the stock, like before ordering, we need to check the items on each and every whatever is left, and we'll know that how much we need for that code, item code,
Yes.
whatever code. Yeah, something like that. I don't know.
Okay. No, you're on the right track. But let's put whatever you're saying into 2 words. 2 words only. When you
I'm so
perform a
detailed.
count, 2 words. So, all right, it just helps you to detect errors. Number 1, and to also identify material misstatements. I repeat, inventory counts helps you to detect errors as well as to identify material misstatements. Material misstatements pertaining to what? To inventory management. So what could happen is there could be errors in maintaining of inventory balances. So they will tell you maybe that like when they are determining the value of goods which are available, they might make an error of missing some of the inventory, and they might record less inventory than what they actually have. So it can be just a pure error, human error, or it can be intentional. And the moment it becomes intentional, it means that it's now a misstatement. There's manipulation taking place, or there's fraudulent activity taking place. The moment it happens like that, we have a problem. Then we call those misstatements or material misstatements. So they intentionally misstate the inventory records in their financial statements, or be it in their financial records. So they will write, for example, that they know for sure that the value of inventory in the warehouse is only worth 50,000 rands. But what they will capture in their books maybe would be 60,000 rands worth of inventory. Notice the difference. Actual, according to the warehouse, they're saying they've got 50,000 rands worth of inventory, but according to what management decides to record on paper, they would say, no, let's put 60,000, let's just increase it by 10,000. What has happened there? There's a misstatement now that has taken place, and this is an intentional misstatement. So we call that material misstatements. So misstatements is just 2 things. It's either an overstatement, or an understatement. Right? Okay, let me call it back. So misstatements, as I was saying, in 2 ways. It's either we overstate something or we understate something. When we overstate, we are recording more than what we actually have. That's overstatement. When you understate, you are recording less than what is actually existing. So giving a typical example of inventory, let's say the inventory value that we have, which is according to the warehouse, they're saying the value of inventory on hand is 50,000 rands. And there's about 10 items there. Then the one they will capture in the financial statement will be 60,000 rands. And that is basically to denote maybe there's 11 items. So do you see that there is an overstatement in our records? I'm talking in this case in the financial statements. So it means that there is, in that context, we can call that a possible fraudulent or management fraud that is taking place, because they know for sure what is on paper. Why? Because they'll perform inventory counts. So even after performing inventory counts, they don't make adjustments to their financial statements. Guess what? We call that an intentional material misstatement. So if I'm to conclude as an auditor, I would simply say that, well, the audit is modified. And if an audit is modified, it means there is a problem. Management needs to act with immediate action. But if it's an unmodified audit report, I'm just trying to give you insight of some things. So when given unmodified audit report, it simply means that there is no issues that auditors discovered. In other words, there is no errors, there was no misstatements, or the misstatements or errors identified, they did not necessarily reach to the materiality level of the organization. Why? Because some organizations, for example, like, I don't know, I mentioned names, there are big organizations where for something to be considered material, it has to reach 1 million. So if it's less than 1 million, it's not considered material. Though, yes, it's a problem and it needs management attention before it actually matures, right? So inventory counts, they are there to account for two things, just to ensure that we detect possible errors when it comes to inventory management and recording, or possibly to identify material misstatements in the financial statements. That's the purpose of inventory counts. So what can happen, you can be required to perform substantive procedures to confirm the inventory account balance. Remember I told you about that earlier. Now, what is the role that management do? Management just basically implement the inventory management policy. What do we do as auditors? We evaluate how effective, how adequate the inventory management policies is. They also ensure regular inventory counts are conducted. But what do we do ourselves? We evaluate the adequacy and effectiveness of the inventory count process. So let me take you briefly through the inventory count procedures. When you look at inventory count, just few important things I feel you need to know. Number one, inventory count is structured in 3 steps. There's what we call before the count, there's what we call during the count, and there's what we call after the count stage. That's how inventory counts are performed. So during the before the count, all they're simply doing there, number one, all they're simply going to do, number one, they'll plan. They'll establish a planning meeting where they'll discuss how the inventory will be counted, what inventory items will be counted, when they'll be counted, and who will perform the count. They'll also give floor plans, and preparation of the warehouse and stores should be done during the planning meeting. So when inventory counts happen, they don't just happen at random. No, they would have already planned for it ahead of time. Then the stationary requirements established before the count, even the instructions of how the inventory counts are to be conducted is done before the count. So stationary requirements, my sisters, it refers to the type of documents that they would use, and even any other stationery possibly used for the purpose of performing the inventory count process. So this would involve inventory tags, inventory count sheets. On the inventory count sheets, that's where each counter would be recording what they've counted and the quantities or differences of which they've discovered during the count. And also the use of inventory codes is important, because the inventory codes would help you to detect the type of inventory and weights located in the warehouse. You use inventory codes. Then there's the count sheet register, just to ensure that there's monitoring and evaluation of the count teams. So they need to sign the register, and they need to sign, and the supervisor also countersigns the register, so that we can be assured that the count is really taking place. So even before the count, in as much as the meeting is taking place, one of the other things that happens during that planning meeting, instructions of how the count is to be performed, who will be responsible for what, how are they going to be performing the count. In other words, the count method will also be discussed during that planning meeting. And observe, these 3 distinct things are happening before the actual inventory count is performed. Then once we have established the planning meeting, established the stationary requirements, given instructions to the count teams, the next important thing is to then go about to conduct the actual count. So what happens during the count? We see count teams performing the count. Count teams, normally they are constructed of 2. There's one person that is who is an actual employee of the company. The second one is just somebody that is hired specifically for the purpose of the count. So there'll be 2 counters normally. But some organizations, depending on how big they are, they might have 2 or 3 or even more. But very important, there is a need for us to have one of the people being an external party, independent of the organization. In other words, not a full-time employee to the company. Then the floor plans should be used by the count teams. The supervisor need to authorize. In other words, he or she needs to exercise what I would call control over forms. Control over forms simply means that the supervisor is the one in custody of the count sheets that are being used. In other words, no counter should just easily have access to the count sheets at their disposal. It should be authorized by the supervisor. Counted items should be clearly marked. The use of ink or pen to avoid unauthorized changes can be deployed. Cross out blank lines on the count sheets. Control over moving inventories. Very important. We cannot consider sold inventory as part of inventory on hand. Never. Even if the inventory is still in the warehouse, but for as long as there's some sort of record that shows that, okay, this part of inventory has actually been sold to a third party, we cannot consider that value of inventory to be part of our inventory on hand, because inventory on hand, it's basically the inventory stock of goods that is available at the end of a particular financial period after we have already sold some of it. So cut-off period is important. Right. And okay, so obviously during the process, the supervisor inspects all the all the items that have been counted. So he comes now and then just to observe them as they are performing the count. And there has to be control over absolute inventory. There needs to be control over damaged inventory, as well as control over consignment goods. What do we mean when you're saying consignment goods? Consignment goods, my sisters, you normally see this when the company is holding or keeping inventory on behalf of another organization. So it's inventory that is just in their warehouse together with their own inventory goods. But the part or that portion of the consignment goods, it's not their goods. It really belongs to somebody else. So it could be that maybe they are storing that inventory for a particular fee from another organization. That's consignment. Then damaged obviously is part of our inventory goods. They can also be consignment goods which are damaged. So even on the count sheets, as they are doing the count, they have to show or they have to reflect them. Making sense? Lovely. Don't worry, we are almost done. After the count. So after the count, the supervisor has to exercise control over the completed sheets. So what do we mean? He collects all the count sheets and ensures that all the counters signs the count registers. And again, another thing that should happen, the supervisor should check that all the items have been counted. Question is, how does he check? So he looks at what these counters have recorded on paper, observes the warehouse section, which these counters have been performing the count, and they'll be able to see. That's why those counted inventories should be ticked or should be marked. All right. Sister Sina, you must be familiar with something I'm talking about here. Right? You're muted, I can't hear you.
All right.
These are some of the things you guys do, right? To facilitate an inventory count.
Yeah, I just process. You bring the file, I punch, and then I give the report.
Yes.
Oh, okay.
And then when I'm done, call you, you'll come and get your file.
Yes.
Fine.
Ah, I see.
Done.
I see.
But we reconcile. Yes, yeah.
Well, you do, yes. The reconcile, yeah, that is important because you want to make sure that what these people have recorded on their paper tallies with what they've actually done in the warehouse, and also tallies with the adjustment done to the financial records or the financial statements. Because you discover normally when inventory counts happen, even the value which they have in the financial statement can change even effectively. Then obviously, reconciliation between physical inventories on hand and the theoretical records should also take place. And we do the necessary adjustments. And that brings us to the end of inventory and production cycle. In the next session, we will be doing a question. So, any questions for me before we can close? I want to release you now.
Thank you.
Sister Sina is muted.
Sister, you're muted.
Now
So, okay, are you going to send us this?
They're not. Definitely.
Can we print?
Yes, you can. Definitely you can. I'm going to forward them to you via Gmail now.
Okay, so that we can print